$3 trillion market is quietly cracking, and most people have no idea it's even happening. Private credit. For the last decade, it was the hottest trade on Wall Street. Hedge funds loved it, pension funds piled in, regular investors were told it was the smart money's secret weapon. High returns, low volatility, and none of the drama of public markets. Turns out there was plenty of drama, and it was just hidden. Right now, as of April 2026, that market is showing serious signs of stress, and the implications go way beyond a few fund managers having a bad quarter. Let's break it down. But first, what is private credit? Private credit is what happens when a company needs a loan and decides, let's skip the bank and call Wall Street directly. Instead of borrowing from JP Morgan or issuing bonds to the public, it borrows from a giant private fund like Apollo, Ares, or Blackstone. Companies went there because the money was faster, more flexible, and more likely to show up, especially if they were too risky, too leveraged, or too complicated for traditional banks. Investors piled in because the pitch was simple: higher yield, floating rate income, and less day-to-day market noise. After 2008, banks pulled back, private funds stepped in, and that gap turned into a market worth roughly around $2 to $3 trillion. Here's the thing about lending money at high interest rates to mid-sized companies. It works great when those companies can actually afford the payments. Since 2022, rates surged, and those same borrowers are now crushed under debt service costs they weren't built to handle. And instead of defaulting outright, which would look bad on paper, lenders and borrowers have been doing something called a distressed exchange. That basically means they quietly rework the loan, push payments further out, change the terms, or use a PIK toggle, short for payment in kind. That's when the borrower stops paying interest in cash and just adds that unpaid interest onto the loan balance instead. So the debt doesn't go away, it actually grows. It's basically kicking today's cash problem down the road and hoping future you can handle it. According to Fitch, which is one of the major credit ratings firms that tracks defaults and credit stress, distressed exchanges accounted for 94% of all private credit downgrades over the past 12 months. In other words, most of the stress in private credit isn't showing up as clean, headline-grabbing defaults. It's showing up as troubled borrowers restructuring their debt on worse terms to avoid defaulting. In other words, the market has basically been running on financial duct tape. Now here's where things get more complicated for everyday investors. Private credit managers began wrapping these loans into semi-liquid products like interval funds and non-traded BDCs. Those vehicles opened the door to retail money, but they did not offer true liquidity, only limited windows to cash out. The sales pitch was appealing: access private credit returns while still being able to redeem periodically. And now the biggest names are showing exactly what that looks like. Ares is one of the clearest examples. Investors asked to pull out 11.6% of the fund, but Ares is only honoring the usual 5% quarterly limit. So the simple version is, a lot more people wanted out than the fund was built to handle in one go. Apollo ran into basically the same problem. Its Apollo Debt Solutions Fund got redemption requests equal to 11.2% of shares, but it also stuck to the 5% limit. In plain English, investors wanted the exit faster than the fund was willing to hand out cash. BlackRock saw it too. Its HPS Corporate Lending Fund got about $1.2 billion in withdrawal requests, roughly 9.3% of net asset value, and paid out only the amount allowed under its 5% cap, about $620 million. That matters because it shows this is not some isolated problem at one shaky fund. It's showing up at multiple of the biggest names in the business. Blackstone is a little different, but not exactly comforting. Its giant BCRED fund didn't clamp down the same way. Instead, Blackstone raised its usual redemption limit from 5% to 7% and put in $400 million of its own money to meet all withdrawal requests. But the fact it had to do that after $3.7 billion worth of withdrawals and then posted its first monthly loss in more than 3 years in February still tells you the pressure is real. And Blue Owl went a step further in the cycle, selling $1.4 billion of debt assets and permanently halting redemptions at one fund to return capital and pay down debt. So this isn't just one manager having a rough week. It's multiple big names all dealing with the same ugly problem. Too many investors want liquidity from assets that were never built to be liquid. So that's the bigger message here. When Ares, Apollo, BlackRock, and Blackstone, and many more firms are all dealing with redemption pressure in different ways, This stops looking like a one-off fun problem and starts looking like a market-wide stress signal. Some firms are capping withdrawals, and others are stretching to meet them. But either way, the message is the same. Investors want liquidity faster than these portfolios can comfortably provide it. And going forward, that likely means tighter lending, more caution around valuations, and less room for weaker borrowers to refinance on easy terms. And another issue facing private credit is software. A big chunk of private credit is tied to software companies. For years, those looked like great borrowers. Steady subscription revenue, loyal customers, predictable cash coming in. Basically, the kind of businesses lenders thought were safe. But AI is starting to change that. New tools are showing up fast. Some are cheaper, others do the same job better, and some make older software look a lot less essential. So if customers start switching or paying less and cutting software they no longer need, those companies bring in less money. And if the company looks weaker, the loans backing it looks weaker too. That's why this matters. It's not that AI is blowing up private credit overnight. It's the fact that one of private credit's favorite borrower groups, software companies, suddenly doesn't look quite as safe as it did before. The DOJ has already flagged concerns about how private credit firms mark the value of their own portfolios, because in this world, assets are marked to model, not to market. Meaning the firm decides what things are worth. That's like grading your own exam. Jamie Dimon, CEO of JP Morgan, has been using the cockroach analogy. When you spot one problem, there are usually more nearby. Jeffrey Gundlach, founder of Double Line Capital, went a step further, calling semi-liquid private credit ETFs the ultimate sin and flagging the whole space as a candidate to start the next financial crisis. Private credit is showing real stress now. When the biggest firms are capping withdrawals or are working overtime to meet them, and listed private credit vehicles are trading below the value they claim for their portfolios, that is the market telling you confidence is slipping. And if that continues, the next phase is pretty obvious. Tighter lending, harder refinancing, more markdowns, and more pressure on weaker borrowers in a market where Fitch says defaults already hit 9.2% last year. So what do you watch from here? More redemption gates, more valuation cuts, and more signs that funding is drying up. This may not be 2008, but it is a very clear warning that private credit stress test is here. If you liked that, subscribe for more.